Hey, how's it going, guys? Today's topic, I want to go in depth about TransAmerica Annuities and fully explain the good, the bad, the ugly, really give you a sense on when an individual should be leveraging an annuity or in particular TransAmerica Annuity, and then also when they should run for the hills. So by having this knowledge, it's going to allow you to say, okay, is this a specific tool that I can utilize for my retirement planning needs that could help me in a situation, or is it going to be able to, or is this going to hurt my situation? And really distinguish the differences there. When I'm going over kind of the concepts, be mindful that you have hundreds of different options available. So for an individual, let's say is age 60, that's looking to, trigger income in a couple of years, it might be company XYZ might be better than Transamerica, as opposed to if you're looking for growth, maybe Transamerica might be better than, these other, 10, 20 different options. So just, have an open mind when you're looking at these different areas. Because I'm obviously going to go into details, but look at any sort of annuity like an individual tool in a tool belt. Is it going to help your retirement situation, or is it going to hurt you? If it's going to hurt you, then obviously avoid that scenario. So there's really two main areas when utilizing a Transamerica annuity, or any annuity for that factor, that you should try to categorize and say, okay, is this going to help out my retirement situation to maximize my income and produce some sort of lifetime income stream? Or am I looking to leverage this specific account for a growth play? Meaning that maybe income is not important, but you want to have the safety that the insurance company is offering you. You want to have the safety mechanisms behind this to grow your account safely. So this is going to go more along the lines from a growth side, more along the lines when you're looking at fixed or fixed index related products of type of fixed income, of a bond type position or a bank related product. That's the way to categorize these things. Too often individuals try to mold both into one area, and that could blow up in your face. Something that's not going to be a good impact from an income play, and also not going to be a good impact from a growth related play. And all that's going to happen is you're going to get handcuffed and squeezed into a non-flexible product line that could also have a lot of large costs. So you're basically sitting there, you can't remove your dollars, or else you'll get hit with surrender charges, and it could just be a huge mess. So, when looking at this, say, okay, I want to utilize either Transamerica product or any sort of annuity product because it's going to put me in a better income position than what I'm at right now. It's going to give me that peace of mind that I'm going to be receiving income, or it's going to give me peace of mind that I have no downside risk from market loss, or I could have upside growth potential. And those are really more of the fixed index realm. And I'll go over really variable annuities and the variable annuities that Transamerica offers and why I absolutely despise those. I do not like those at all. So you'll kind of see the method behind the madness. And to piggyback off of that concept, what are Transamerica annuities? And basically Transamerica annuities, they allow you to leverage their products to produce lifetime income in retirement, or you could produce some sort of growth play in retirement. So what that would do is you'll use an annuity. Annuity is basically the opposite of life insurance. So with life insurance, an individual will get that to protect that risk of dying too soon. If an individual is paying monthly premiums or annual premiums into a life insurance policy and they passed away, then you're going to have a lump sum benefit is going to go to beneficiaries upon that individual passing away. So it protected that individual from passing away too soon, or whenever they passed away, there was some sort of protection there. Now, if you flip that, the complete opposite is what an annuity from an income purpose would basically give you. So what's happening is the insurance company is leveraging all the actuarial data that statistically shows how long an individual should be living. And what they're saying is, if you give us a lump sum, we're going to produce you income that you can never outlive. So case in point, if let's say somebody gave $100,000 to an insurance company and they were getting an income annuity, and the insurance company says, okay, based on your age, all these different factors, we're going to pay you $10,000 per year for the rest of your life, or yours and your spouse's life. So in that scenario, if you had a bucket of $100,000 that was basically sitting there, if you siphoned out $10,000 per year, after 10 years, you would run that well dry. You'll have no more money there. The annuity, what's happening is the insurance company is now taking on that risk to say, we're going to pay you $10,000. If you live for 20 years, you would have only given us $100,000. Every dollar past that 100,000, that's now the risk on their books, and they're paying you that extra 10,000. So in that example, you would have given them 100,000. You would have been paid back $10,000 per year, lived for 20 years. That's a $200,000 benefit. So that's where it makes mathematical sense. So from an income side, what you should look at is really look at your mortality. If you're, significantly older, or let's say you don't have longevity on your side, or you've had heart attack, stroke, different things that could prevent you from living a long life, that maybe statistically you should not leverage an annuity for that lifetime income play. But other individuals that say, okay, I feel like, I should be able to live long. I feel like, my longevity is on my side. I want to make sure that I'm placing my money, I'm having some sort of insurance, that if I give my money to an insurance company, I'm going to be able to receive lifetime income that I can never outlive. So in that example where you would run your well dry, you won't do that if you have an income related, a retirement account or an income related annuity account for that cash flow. But that's where things get a little bit dicey, because like Transamerica, they'll offer different income related annuity product lines. But if that's coming back in 30th place out of hundreds of options, why would you go with that company? Why would you go with that income offer? Like, as the example of, let's say you give $100,000 to the insurance company and Transamerica is offering you $7,000 of lifetime income, but you have first place that's offering you $13,000 of lifetime income, and it's the same rated carrier, has all the same components involved. Why would you not go with that superior product as opposed to the inferior product? So that's the way that you really have to dissect these things and say, okay, let me run it through the gamut and say, is this going to be the most mathematically appropriate for my position, where I could either use the smallest dollars only as much as necessary to produce me the cash flow needed, or will this be a detriment? Why would I go and have an inferior cash flow if I could have all these other carriers that would be significantly better? So that's the way to really, correlate these things or understand these things. Now, for the individual that's looking more towards, I don't necessarily need this for income, but I just want to have some sort of protected growth on this. This is where you could leverage fixed related accounts or fixed related annuity accounts or fixed index related annuity accounts. And then you have more of that variable side, which is known as a variable annuity, where you have sub-accounts and kind of like mutual funds, which are very expensive, which I'll, go into that. But really, the case in point is whenever someone's looking to utilize a Transamerica annuity, it can provide you income, lifetime income, and it could also provide you growth. But that does not mean that you should just 100% go into it. The logic and the concept of it can make sense, but it could still be a shitty product if, and you could really be throwing thousands of dollars in the wrong direction if you don't really dissect what some of the best ones are, available. That's one of the things that obviously you'll see our 1-800 number up on the screen, and you can feel free to reach out to us at any time. I'll have also the calendar link in the description of this video. But whether you want to call the 1-800 number, 1-800-566-1002, or set up the actual appointment through our calendar link, what you'll do is be able to speak with one of our advisors, potentially myself as well, to go over your current situation and see, okay, you were obviously shopping different annuities is the reason why you looked at this video, but how does it correlate to your overall picture, to your overall retirement plan or retirement strategy? You have to have some sort of strategy. You can't just hope that a product is going to do all this whole jack of all trades type concept. We have a trademark process known as the retirement diet plan, where we basically create 4 and 5 different worlds to help an individual understand where a sliver of it might be necessary for a specific annuity account and how that annuity account can help them. But that doesn't take away from all the other areas that you should really be looking at for an actual plan for your scenario. So just be mindful of really what are Transamerica annuities, what are some of the different things they could do, but then let's go more into the minutia and saying when can it be effective or when should you avoid it. So if somebody had the need to produce some sort of income, some sort of cash flow from it, they could utilize a Transamerica annuity for their income rider, and be mindful that an income rider is just producing lifetime income. It's not the actual growth on that individual's account. So like you might see these different things that show you like a bonus, or it shows you a roll up of 7%. And all that is just a calculation. So what that's saying is, just like to my original point, if you go and you put X amount of dollars with this insurance company and they're saying we have an income rider associated with this account, all that income rider is going to do is just give you lifetime income. That's not going to give you a guaranteed growth on your account. There's a large misconception. That's a large problem that advisors don't really explain that properly. And an individual, after they're already a couple of years into the product, they realize that and they've been paying for this rider fee, even if they didn't want the income to begin with. And it's just it's a huge mess. So be mindful of the difference between an income rider versus the actual growth, the actual guarantee on the product. The other aspect would be if somebody says, okay, I want to utilize this sort of this sort of product line for growth, for like safe accumulation growth through a fixed or fixed index related account, and I just want to kind of take off whatever I gained each year. That's where you could utilize free withdrawals for income purposes. Especially with the higher interest rate environment, it's made this more possible. with some of the options available. So that's something that you're not looking to use for an income rider. You could even get set up with an account that does not have any fees associated with it and take it out in the form of free withdrawals to actually correlate or accomplish what your cash flow need is, what your income need is. So you're kind of having the best of all worlds. You're saying, okay, I'm using this for safety. This is actually growing on a safe, consistent basis. Anytime that I'm receiving gains into my account, I'm going to use that extra gain for income purposes to pay for my expenses that year throughout retirement. So there's some pretty neat things to do with those income plays for annuities. Now for growth, this is where it breaks it down into a few different sectors. I mentioned fixed or MYGA and multi-year guaranteed annuities. So like if you ever see a fixed annuity, especially offered through TransAmerica, they're going to say, based on, let's say, 5 years, they might give you an offer of 2% and saying you're going to receive 2% growth onto your account every year for the next 5 years that are guaranteed by the claims paying ability of the insurance company. Is that good? Well, they're giving you 2% in that example. Sure, you're getting at least some sort of rate of return on your money, but when you're comparing it against the plethora of options available, that's going to be a real shitty option because let's say first place is paying 6%, but then you went with the inferior product line of 2% with TransAmerica because the advisor that you spoke to was just kept shoving TransAmerica down your throat. That's obviously a problem. So you want to be very careful and know that you're getting set up with the best possible scenario. Also, if you have a short-term need and say, hey, I need growth, I need some sort of fixed growth for these next 3 years, but because then I have to liquidate my account and actually use it for some sort of expense-related need, don't get set up in a 5-year account, or don't get set up in a 5-year fixed duration or a 6-year fixed duration because that's not going to correlate to what your goals are. So be very careful there. You have variable annuities, which they go through something called sub-accounts, which are, think of it like mutual funds. So what happens is your account's going to either grow based on how well those mutual funds or the sub-accounts perform, but it's going to go down whenever those investments, it's really an investment, it could go up or it could go down. The problem with it and why I personally hate variable annuities, especially with TransAmerica, is you have high fees associated with those variable annuities. So variable annuities could say, oh, we'll give you some growth, but also you have some downside risk there. But then on top of it, we're going to charge you 1-2% of fees just to be able to get set up into those variable accounts. On top of it, they might also try to add an additional income rider or a death benefit rider, and that's going to add further fees onto it. So this is where the reason why I don't like variable annuities, especially if you're trying to use it for income, is you're going to have the constant fee with the variable sub-accounts, the constant variable annuity fees. If you're using it for income, you're going to have those income rider related fees. And then on top of it, variable annuities are not going to produce you the highest amount of lifetime income as opposed to other sorts of options available. So that's where you want to be very careful with it. Now you also have fixed index, which are protected related accounts. So kind of think of it conceptually like a blend between a fixed and a variable. When what happens is every year on your anniversary date, you're either going to receive a growth or you're going to receive 0%. A growth is 0%. What makes this a good product or a bad product is what are those cap limits? Are there uncapped indexing strategies associated there? Meaning that if, let's say you had, an index that was related to the S&P 500 and it was a 5% cap, if the S&P gains 20%, you're capped at only gaining 5. Yes, if the index, loses 20%, you're going to have a 0% floor, but that cap at 5 could be horrible for a situation. So that's where conceptually, yes, it's giving you growth or it's giving you 0% whenever the market's going down, but always make sure you're controlling your chips the right way and you're using the most effective tool as per your needs, as per your specific situation, and don't just go into a product because it has the TransAmerica name behind it. TransAmerica could be the correct option, but you really want to look at more of what's your situation, what's your time horizon, what's your risk, all these different factors to make sure that, it's going to be something that would be suitable for your situation. So when we're looking at the actual TransAmerica website and you're looking at the annuities, you say, okay, which is going to be the best for my situation? This is where it really correlates to what the presentation I was just speaking about, structured annuities. So you can structure annuities out in fixed related structuring, meaning a certain duration of time, or the fixed index related accounts. So you have different durations of 10-year, 5-year, 6-year. Each, basically whenever you're reviewing what their product lines are, they're going to have specific ones that might be available or might not be available, based on that exact time horizon, based on the interest rate environment and all of that. So that's where if you want to learn more, you'd obviously click on the learn more over here on the structured side, but that would be more of the safer play. The variable annuities, what I was mentioning, has the sub-accounts, has the different fees associated with it, And then when you see things with the living benefits, this is saying you could customize your variable annuity, meaning a variable annuity with an income rider, and you could look at that. Now, once again, you have to be very, very careful with these things. Sometimes Transamerica could be a fantastic avenue. Sometimes it could be a complete nightmare. But do not just get pigeonholed into it because the advisor that you were speaking with was just kept shoving Transamerica down your throat. You understand that the individual has the power. The insurance companies do not. So if you have hundreds and hundreds of different options available, use the best options or even use combination of those options. Don't just get penciled into one area that could basically shove you between a rock and a hard place. Hit you over the head with a bunch of fees, have no growth or very limited growth, and you're basically just sitting there and, what happened? Well, the advisor that set you up on this is just getting a nice fat commission and, it didn't give you any benefit. So that's the thing is, obviously annuities can be fantastic tools, but you always just want to understand that you have the flexibility, you have the power. There's certain ones that are much better than others, and it's really based on what your goals are and what your situation is. So in closing, I hope you found some value in this. Kind of gives you a nice generic understanding of the different annuities available, how Transamerica has some different offerings. But, at the end of the day, it's most important to really understand what your situation is, what your dream retirement scenario is, and don't just leave it to chance. Don't just say, okay, well, I felt like this person was a nice guy, and that's why I'm just going to go with this suggestion and not really understand anything. You want to be educated on it. You want to see the pros, but more importantly, you want to see the cons. And if you shoot enough holes into different product offerings and still left standing, well, then maybe that might be a viable solution. If not, if you do not fully understand the cons, when in doubt, don't. So do not get set up with that. One of the things that we offer is we run stress tests. So whether you're set up in a Transamerica annuity, you're trying to get out and see if there is some favorable options. Obviously, you could feel free to reach out to us through the calendar link or call a 1-800 number, 1-800-566-1002. Be mindful that also because you have a much higher interest rate environment in just these past 12 to about 24 months, when the Fed has increased interest rates, it's now had a trickle-down effect on some of the best, safer annuity accounts from an income play, from a fixed play, from a fixed index play. And those are really, been some good solutions to either get out individuals that had bad annuities and actually replace them and put them in a better scenario, or take advantage of some of those shorter terms and something that would correlate and give you the most amount of flexibility, potentially that do not have any fees associated with it or give you max cash flow need. And there's a couple of really neat things to do. So I want to thank you very much for watching this video. Feel free to subscribe to our YouTube channel. Now, be mindful, this is the YouTube channel Annuity Scan. Our main channel is called Retire Sharp. What I did was I created Annuity Scan to just go primarily because we've had different prospects and clients call in to say, hey, could you go and make actually individual videos for these individual product lines? So that's why I created this portion of the channel specifically for just annuity reviews. But at any point in time, you could review our content, review our website, and we'll be happy to try to help you out the best we can. Thanks so much, guys.